I want to talk about trading with the trend. Many trading mentors recommend trading with the trend, not against the trend. Trend is your friend. In general, this makes sense because as traders, we want to go with the market sentiment to catch the large moves. If the market is strong and the buyers are in control, we will look for buy opportunities. But here comes the tricky part: how to identify the trend. It's tricky because most of the tools for identifying trends lag. One example is the moving average or exponential moving average, the EMA. Identifying trends is tricky because in technical analysis, most tools like the EMA lag, meaning they identify the trend after the fact. In addition, they highly depend on the time frame. Let's take an example here. Now let's take a look at the Nasdaq here. On a 1 minute time frame, it clearly shows that Nasdaq is in a downtrend. And if we put the EMA here, we can see the price is below the moving average, meaning it's a downtrend. Now, if we switch to 15-minute time frame, we will see exactly the opposite. And if we put the EMA, we will see that the price is above the moving average, meaning it's an uptrend. So two different time frames show exactly the opposite. Now I want to go through the market analysis we did together in the live session last Thursday, and I want to explain several things. So I have the Nasdaq in the right side and ES in the left side. The indicators I have on my chart are the trigger point, the key levels, and the confluence indicator responsible for generating the buy-sell signals here based on statistical methods. Regarding the trigger points, I have the current day's trigger points, red and green levels, and the previous day's trigger points in orange. So looking at ES here, the market is with a high distance relative to each one of the trigger points. And let's start by running and analyzing. So see several interesting phenomena here. The first is what happens when there are trigger points with a low distance between them. We expect this behavior, in many cases, this consolidation here until it breaks. Okay, and here I think there was a high impact news. It bounced off resistance several times, as you can see here, and then it bounced off this support level. So we identify strong reaction of the markets to our trigger point. So at this point, there are many trigger points for NQ, but a very few lines for ES, making it harder to identify correlation-based opportunities. Okay, so by reading the price action here, we can see the sellers are pushing off res 0, indicating that the market is about to go to the downside. Now, let's take a look here. Finally, ES reached its support level, broke a little, but then it indicates a false breakout. Now, I want you to see. There's an intraday support level generated by NQ here, according to the double bottom or triple bottom here. At this point, a buy signal was generated on ES, indicating it's a false breakout. Retest. Okay, so NQ created an intraday support, then retest of this support by the time ES retested its support. So the buy signal here and the double bottom here indicate that there's a strong support here. Now, it happened a few minutes after the market opened, meaning we identify the reaction of the markets relative to a support level, indicating that the buyers are taking control. They avoid the market from going to the downside. Okay, buy signal, support level, a small, very small forced break to the downside, then the buyers are pushing here, retest, and the market goes to the upside. Okay, now, because there's a resistance level here, we expect this to bounce back. Another support here, we expect this to bounce back. Now, a very important point, guys. There are many trigger points here on NQ. Only a few on ES, but many trigger points here on NQ. This often indicates that the market is going to consolidate, moving between the levels. Okay, so the trigger points can also indicate ahead of time zones that the market is expected to consolidate. And why? There's a very simple explanation. Because the market tends to respect the levels, because there's a low distance in this case between the levels, distance between levels that are expected to get respected, this means that the market bounced here, then bounced here, then bounced here. So this is a consolidation zone. Okay, so when you see trigger points with a low distance between them, it often indicates that this is a consolidation zone. Okay, now let's continue. Let me write it down. To be a consolidation zone where NQ is okay, so this zone is expected to be a consolidation zone for NQ until it breaks and catches its direction. The expected direction, what we call trend, likely to be an uptrend. Okay, so this zone is expected to be a consolidation zone for NQ until it breaks and catches the direction. The expected direction is likely to be an uptrend because we identified the price action at when the market opened. The buyers were pushing up off a support level, and this often indicates the trend, the market sentiment today. So the behavior of the market relative to the trigger points when the market opens often indicate the market sentiment. To conclude, identifying trends is tricky, and you have to utilize techniques that do not lag. Especially on low time frames, tools like the EMA identify the trend after the fact. In addition, they can indicate different things on different time frames. Confusing. Now, regarding trend is your friend, it's also tricky because you want to sell high and buy low. To sell high, you must go against the trend, right? But let's say we want to trade with the trend. So how to identify the trend without lags? One possible way is to utilize leading indicators like support and resistance and identify the market reaction relative to them. To conclude, identifying trends is tricky, and you have to utilize techniques that do not lag. Especially on low time frames, tools like the EMA identify trends after the fact. In addition, they can indicate different things on different time frames. Now, regarding trend is your friend, it's also tricky because you want to sell high and buy low. To sell high, you must go against the trend, right? But let's say we want to trade with the trend. So how to identify the trend without lags? One possible way is to utilize leading indicators like support and resistance.